Wealth Conversations, your guide to long-term investing. Welcome to Wealth Conversations by FundsIndia. We are here to talk about money. More specifically, we want to discuss how you can grow your money over time. Many people find investing complicated. They see charts and numbers, they hear jargon, and feel overwhelmed. Our goal is to simplify these ideas. We believe that understanding the basics of long-term investing is crucial for financial well-being. It's not about quick wins or chasing fads. It's about a steady, patient approach to building wealth for your future, allowing your aspirations to take flight. Think of this as a friendly chat about your financial journey. We aim to provide insights. We want to share knowledge that empowers you. Long-term investing is a powerful tool. It can help you achieve significant financial goals. This could be buying a home. It might be funding your children's education. Or perhaps it's ensuring a comfortable retirement. Whatever your dreams, a sound investment strategy can be the bridge to realizing them. We are here to help you understand how to build that bridge, brick by patient brick, ensuring it stands strong. The world of finance can seem daunting, but the core principles of successful investing are often surprisingly simple. They revolve around understanding risk, being patient, and letting the power of compounding work for you. At FundsIndia, we believe in equipping you with this understanding. These wealth conversations are designed to cut through the noise. We focus on what truly matters for long-term success. We will explore different concepts clearly. We will show you how seemingly small steps taken consistently can lead to substantial outcomes over the years. Our journey together starts with the basics. We will explore what long-term investing truly means. We will look at how different investments behave. We will discuss the importance of staying the course, even when markets seem uncertain. This is not about predicting the future. No one can do that reliably. It is about preparing for the future by making sensible decisions today. So let us begin this conversation. Let's explore the path to unlocking wealth through the proven power of long-term investing, one clear concept at a time. The investment landscape understanding asset class performance. To invest wisely, we first need to understand where we can put our money. These places are called asset classes. Think of them as different types of financial tools. Each tool has its own purpose and characteristics. Common asset classes include equities, which are shares in companies. There is also debt, which is like lending money for a fixed return. Gold is another popular asset, often seen as a store of value. Real estate, owning property, is also a significant asset class. Understanding these categories is the first step in building a robust portfolio for your future needs. Now, let's look at how these asset classes have performed. Data as of April 30th, 2025 tells an interesting story. Over very long periods, equities have generally provided the highest returns. For example, over the last 20 years, Indian equities have significantly outperformed fixed deposits, gold, and even real estate in many instances. This doesn't mean equities go up in a straight line, they have their ups and downs. But the long-term trend has been upward. This outperformance is a key reason why equities are often central to wealth creation strategies designed for the long haul, offering growth potential. Consider this: if you had invested 10,000 rupees 2 decades ago, where would it have grown the most? Historical data strongly suggests that an investment in a diversified basket of equities would likely have yielded a much larger sum compared to keeping it in a savings account or even gold. Debt instruments, like bonds or fixed deposits, offer stability and more predictable, albeit lower returns. Gold has its moments, especially during times of uncertainty, acting as a safe haven. But for sheer growth over extended horizons, equities have historically led the pack, rewarding those with patience. This historical performance is not a guarantee of future results. The world changes, economies evolve. However, understanding these long-term trends is vital. It helps us set realistic expectations. It guides our decisions about how to allocate our precious savings. The key takeaway is that different asset classes play different roles. Equities have been the engine of growth for many long-term investors. Recognizing this pattern is fundamental as we delve deeper into crafting an effective investment plan for your financial ambitions and security. India's growth engine, the story of Indian equities. Let's focus on Indian equities. When we talk about Indian equities, we often refer to indices like the Nifty 50. The Nifty 50 represents the 50 largest and most liquid Indian companies. Its journey over the past few decades reflects India's economic growth story. It has seen remarkable expansion. From humble beginnings, it has climbed to significant heights. This growth wasn't always smooth. There were periods of stagnation and decline, but the overall trajectory has been unmistakably upward, mirroring the nation's progress and burgeoning industrial strength. Within the broader equity market, companies are often categorized by their size. This size is called market capitalization. It's simply the total value of a company's shares. Large-cap companies are the giants, well-established and stable. Mid-cap companies are smaller but often have significant growth potential. Small-cap companies are even smaller, potentially offering higher growth but also carrying higher risk. Each segment has performed differently at various times. Sometimes large caps lead. At other times, mid-caps or small caps might outperform significantly, offering exciting opportunities for discerning investors. Historically, Indian mid-cap and small-cap stocks have at times delivered higher returns than large caps over certain extended periods. However, they also come with greater volatility. This means their prices can swing more dramatically, both up and down. Large-cap stocks tend to be more stable. They form the bedrock of many long-term portfolios. Understanding these differences is key. It helps in building a balanced equity portfolio that aligns with your risk tolerance and investment horizon. A mix can often provide a good blend of stability and growth potential for the journey ahead. The story of Indian equities is one of dynamism and potential. As India continues to grow, its companies are likely to grow too. This provides a strong backdrop for equity investors. Investing in Indian equities is like participating in the nation's economic journey. It requires belief in the long-term prospects. It demands patience to ride out the inevitable fluctuations. But for those who understand the landscape and stay committed, the rewards can be substantial, contributing significantly to their financial aspirations over many years of disciplined participation. Time, not timing. The investor's true ally. Many people believe that successful investing is about timing the market. They think they need to know the perfect moment to buy low and sell high. This is a very difficult game to play. Even seasoned professionals struggle to time the market consistently. The truth is, for most investors, success comes not from timing the market, but from time in the market. The longer you stay invested, the more you allow your investments to work for you. This principle is especially true for equities, where short-term movements can be unpredictable, but long-term trends are often more favorable. Consider the impact of your investment horizon. If you invest in equities for just 1 year, there's a chance you could see a negative return. Markets can be volatile in the short term. However, if you extend your investment period to 5 years, the likelihood of experiencing a negative return typically decreases. If you stay invested for 10, 15, or even 20 years, historical data shows that the probability of losing money in a diversified equity portfolio becomes very small. Furthermore, the average returns tend to be more attractive over these longer durations, smoothing out the bumps along the way. Volatility is a word often associated with equities. It refers to the ups and downs in prices. This can feel unsettling. Nobody likes to see the value of their investments fall. However, time has a wonderful way of smoothing out this volatility. Short-term fluctuations, which might seem alarming on a daily or weekly chart, often become minor blips when viewed over a span of many years. Patience allows the underlying growth trend of good businesses to assert itself, overshadowing the temporary market noise and sentiment-driven swings that can distract less experienced investors. Therefore, the focus should be on how long you plan to stay invested, rather than trying to predict the market's next move. If you have a long-term goal, like retirement or funding a child's future education decades away, equities can be a powerful ally. Give your investments the time they need to grow. Resist the urge to react to short-term market news. Embrace the power of time in the market. It is one of the most reliable friends an investor can have on their journey to financial well-being and achieving significant life goals. Section 5. The Eighth Wonder. Unveiling the Magic of Compounding. Albert Einstein purportedly called compounding the eighth wonder of the world. It's a simple idea, but its effects are profound. Compounding is essentially earning returns on your returns. Imagine you invest some money. It earns a return. The next year, you earn a return not just on your initial investment but also on the return you earned in the first year. This process repeats, year after year. It's like a snowball rolling downhill. It starts small, but it picks up more snow and grows bigger and faster over time. The real magic of compounding unfolds over long periods. The longer your money stays invested and continues to compound, the more dramatic the growth becomes. This is why starting to invest early can make such a huge difference. Someone who starts investing in their 20s even with small amounts can often accumulate significantly more wealth than someone who starts in their 40s with larger amounts. The extra years provide more time for the compounding engine to work its wonders, turning modest savings into substantial nest eggs through persistent growth. Let's visualize this. Imagine two friends, Anya and Ben. Anya starts investing 5,000 rupees per month at age 25. Ben starts investing 10,000 rupees per month at age 35. Assuming they both earn the same average annual return, say 12%, by the time they reach age 60, Anya would likely have a much larger corpus. Even though Ben invested a larger monthly sum, Anya's early start gave her investments more time to compound. The growth in the later years becomes exponential. This is the power of giving your money time to multiply itself repeatedly. This principle is not just about numbers, it's about patience and discipline. It requires you to reinvest your earnings, allowing them to become part of your capital base. It means resisting the temptation to withdraw profits prematurely. Compounding rewards those who stay the course. It is the quiet, steady force that builds fortunes over decades. Understanding and harnessing this power is perhaps the single most important lesson for any long-term investor seeking to achieve financial independence and secure their future aspirations effectively. Section 6. Navigating storms. Understanding and overcoming equity fears. Equities, while powerful for long-term growth, come with their share of anxieties. The primary concern for many is volatility, especially market declines. It is natural to feel nervous when you see the value of your investments drop. News headlines can amplify these fears. Commentators might speak of crashes and crises. This can tempt investors to pull their money out, hoping to avoid further losses. However, reacting emotionally to market downturns is often one of the biggest mistakes an investor can make, potentially locking in losses and missing subsequent recoveries. History teaches us that market declines are a normal part of investing in equities. There have been many periods of significant market falls. We have seen corrections where markets drop by 10% or more. We have also witnessed bear markets with declines of 20% or greater. For instance, looking back at the Nifty 50, there have been several such instances over the past few decades. These periods are unsettling, no doubt. But history also shows that markets and strong economies tend to recover and eventually reach new highs over time. The key during these turbulent times is to stay invested. This might sound counterintuitive when fear is high, but selling in a panic often means selling at low prices. Those who remain invested are positioned to benefit when the market recovers. Think of it like being on a ship in a storm. Jumping overboard is rarely the safest option. It is often better to trust the vessel, your diversified portfolio and long-term plan to weather the storm. Market downturns can also present buying opportunities for those with a long-term view and available capital. Understanding that declines are temporary for well-diversified portfolios focused on quality assets can help manage fear. It's about perspective. A 20% drop can feel huge in the moment, but over a 20 or 30-year investment horizon, it often appears as a mere dip on the upward journey of wealth creation. Having a solid financial plan, understanding your risk tolerance, and remembering the long-term growth potential of equities can provide the conviction needed to navigate these inevitable market storms successfully, ultimately leading to better financial outcomes. Section 7. The Art of Balance. Why diversification matters deeply. There's an old saying, don't put all your eggs in one basket. This wisdom is the essence of diversification in investing. Diversification simply means spreading your investments across different assets. The goal is to reduce risk. If one investment performs poorly, other investments in your portfolio might perform well, cushioning the overall impact. It's about not relying too heavily on any single company, sector, or even asset class to achieve your financial goals. This strategy helps in creating a more stable and resilient investment journey. When it comes to equities, diversification can happen at several levels. Firstly, across market capitalizations. As we discussed, large cap, mid cap, and small cap stocks behave differently. A mix can provide a balance of stability from large caps and growth potential from mid and small caps. Secondly, across sectors. Different industries like technology, healthcare, banking, or consumer goods perform well at different times depending on economic cycles and trends. Spreading investments across various sectors avoids overexposure to the fortunes of just one industry. Another aspect is diversifying by investment style. Some managers focus on growth stocks, companies expected to grow earnings rapidly. Others prefer value stocks, companies that appear undervalued by the market. A portfolio that blends these styles can perform well in different market conditions. The idea is that when one style is out of favor, another might be doing better, leading to smoother overall returns. It's about building a team of investments where different players can shine at different times, contributing to the overall success of the portfolio strategy. Ultimately, diversification helps manage the unpredictable nature of markets. No one knows for sure which stock, sector, or style will be the best performer next year. By diversifying, you acknowledge this uncertainty. You build a portfolio that is robust enough to withstand various market conditions. It doesn't guarantee profits or prevent all losses, but it can significantly reduce the volatility of your portfolio and improve your chances of achieving consistent long-term returns, making your investment experience less stressful and more predictable over time. Section 8. Building a resilient portfolio, the role of debt and gold. While equities are a powerful engine for wealth creation, a truly resilient long-term portfolio often includes other asset classes like debt and gold. These assets play different complementary roles. Debt investments such as bonds, fixed deposits, or debt mutual funds are generally considered lower risk than equities. Their primary role is often capital preservation and providing a more stable, predictable stream of income or return. They act as an anchor in your portfolio, especially during times when equity markets might be volatile or declining, offering a cushion. Think of debt instruments as the defensive players in your investment team. They may not score as many spectacular goals as equities, but they are crucial for protecting your capital and reducing overall portfolio volatility. When equities are down, the stable returns from debt can help offset some of those losses, making the overall investment journey smoother. The allocation to debt in your portfolio often depends on your age, risk tolerance, and financial goals. Younger investors with a long horizon might have less in debt, while those nearing retirement might have more for stability. Gold, the precious yellow metal, has a long history as a store of value. In an investment portfolio, gold often acts as a hedge. It can be a hedge against inflation, as its price tends to rise when the general price level increases. It can also be a hedge against economic uncertainty or geopolitical instability. During times of crisis, investors often flock to gold as a safe haven asset. Its price movement sometimes has a low correlation with equities, meaning it might do well when equities are struggling, providing further diversification benefits to your overall holdings. Including debt and gold alongside equities allows you to build a more diversified and all-weather portfolio. Equities drive growth, debt provides stability, gold offers protection during uncertain times. The right mix depends on your individual circumstances. But understanding the role each asset class plays is crucial for constructing a portfolio that can help you navigate different market conditions and stay on track towards your long-term financial objectives, ensuring peace of mind alongside the pursuit of wealth. This balanced approach is key to sustainable financial success. Section 9. Your journey to wealth, embracing the long-term vision. We have journeyed through several key ideas today. We started by understanding FundsIndia's commitment to guiding you through long-term investing. We looked at how different asset classes perform, with equities historically leading the charge for growth. We delved into the promising story of Indian equities and the importance of time in the market over trying to time it. The incredible power of compounding was highlighted, showing how small, consistent efforts can lead to remarkable wealth over decades. These are not just theories, they are proven principles. We also addressed common fears about investing in equities, emphasizing that market downturns are often temporary and staying invested is crucial. The wisdom of diversification across market caps, sectors, styles, and even asset classes like debt and gold was discussed. This balanced approach helps in managing risk and achieving more consistent returns. Each of these concepts is a building block. Together, they form a strong foundation for your financial future. The path to wealth is not a sprint, it is a marathon, requiring patience and a clear vision. The benefits of embracing this long-term vision are immense. It allows you to look beyond the day-to-day noise of the markets. It enables you to harness the true growth potential of businesses. It lets the magic of compounding work quietly but powerfully in your favor. It helps you build a resilient portfolio that can weather different economic seasons. Ultimately, it is about achieving your financial goals. Whether they are big or small, near or far. It is about creating financial freedom and security for yourself and your loved ones. So, the invitation is simple. Start your journey. Start early if you can. Start small if you need to. But start. Learn continuously. Stay disciplined. Embrace the principles of long-term investing, compounding, and diversification. The path to unlocking wealth is not hidden. It is available to everyone who is willing to follow it with patience and perseverance. We at Funds India are here to support you on this rewarding journey. Your financial future is waiting to be built, one sensible investment decision at a time.